Welcome back to another episode of the Retire Right podcast. Today we are continuing a series on, a flight to quality or flight to safe investments, more commonly called safe haven assets. The last episode was on annuities, which I wouldn't say that that's necessarily deemed a flight to quality or a safe haven investment, but you can say, regardless of the downsides, which we talked about in length in our last episode, you could say that, an indexed annuity is a safer investment, especially if you're comparing it to, a stock portfolio. But when volatility picks up in the markets, it's very common for us to get a lot of questions, about, hey, is there something else that my money should be in? It's very natural for investors to wonder if they should, bail on a portion of their portfolio, maybe where they see some red, and go into something that's been talked about in the news or what have you lately. So today we're going to focus on gold. One thing that I want to define before we jump in to the actual, bulk of the episode is a safe haven asset. Again, you can call that a flight to quality investment. Really, the best way to look at that is it's something that, again, if volatility enters the marketplace, that's kind of the area where people will wonder, should I carve off a portion of my portfolio and go into that asset class? So again, today we're focusing on gold, which is deemed a safe haven asset. Nick, is there anything else that you would want to add, about why we're doing an episode on gold at this point in time?
Yeah, it's gone up a lot.
Yeah.
It's the first point to the news. Yeah. And obviously, whenever things go up a lot, there's articles and people start to get interested. But there's things that have contributed to that, especially this year. The tariffs that have been in the news a lot have contributed to people kind of wanting to buy gold and hold gold. There was this inflation post-COVID, as we know, that made people think about, gold's resilience to inflation and possibly being an inflation hedge that caused some demand. Possible inflationary impact of tariffs contributes that as well. And then you talked about as well, like with the market volatility, whenever stocks get volatile, and especially gold's doing well, at the same time, people are always attracted to the idea of owning gold to get out of stock risk or get away from it.
Okay. So related to the point that you made, it's gone up a lot. What's contributed to that?
Yeah. So there are some shorter term things, and so which we just talked about. Right? Yeah, right. The shorter term things I just talked about. And one of the longer term things really goes back to the mid 2000s. A huge thing happened in the mid 2000s, and it was the launch of the GLD ETF. It's just an exchange traded fund that owns a bunch of gold that sits there in a vault. Why was this a huge deal? Well, prior to that, if you wanted to own gold, you had to go buy physical gold, and then you have to store it somewhere. So you're either paying to store it somewhere, or if you're storing it in your home, you're buying your own little Fort Knox setup, right? And the other thing that's tough is then if you want to transact in it, it's really easy to buy gold. It's a lot harder to sell it.
Yeah. Or at least sell it at the price, that you bought it for.
Yeah, there tends to be a lot of big very large
Yeah.
transactional costs, right?
So for a pretty low kind of maintenance cost expense ratio, this ETF made it really easy to buy, hold, and sell gold exposure to ordinary investors and institutions all over the world. And you saw a very sharp step increase in the price of gold in a short period of time after that ETF.
Simply because just more people were able to get into the market at lower cost.
More demand, yeah. More demand, basically same supply, price goes up.
Gotcha. Okay. So the ease of use with the exchange traded funds, that's one thing that contributed to the recent, or has been contributing to the price increase. What else would you want to mention?
Yeah. So more recently, there's this concept or theme called de-dollarization, which if you read a lot of financial news, you'll see articles about a lot, think pieces about a lot. Little background before we get into the details. So countries all over the world, they money moves back and forth between them and between people in those countries. And when you think about what money they exchange, a lot of those flows are denominated in dollars, actually. You'll hear the phrase like global reserve currency applied to the dollar. And that's really why, because it's a currency that countries will just use so they don't have to worry about exchanging between each other all the time. They'll just hold dollars and trade dollars.
Okay.
Why is this a big deal more recently? Well, back in 2021, when Russia invaded Ukraine, the US was very aggressive in essentially cutting Russia out of that system, or trying as hard as they could to cut Russia out of the system. Weaponization of the dollar is the phrase you'll hear. In and of itself, Russia is not a huge component of the global economy, but what this did was get a lot of other countries up in the world thinking about, well, if they can do this to Russia, they can do this to us potentially as well. And maybe we don't want to be at the mercy all the time of the American government's foreign policy objectives. So the big country that impacts the most is China. We have obviously a major rivalry with China right now, but we also have a kind of like weird frenemy relationship with them, in that there were a lot of trade flows. That's in the news all the time. Yeah. And as a result of that, China holds huge reserves of US dollars in the form of our treasury bonds. And so there's a lot of speculation and data to support that more recently China has been starting to sell some of those bonds, or even if they're not selling them aggressively, they just don't want to accumulate much more. And instead, as they need to build their reserves, because of their flows coming into their country, they are accumulating gold instead.
Gotcha.
And buying gold. So again, back to the ETF, supply basically the same, demand way up. It's another factor contributing to demand, price goes up.
So really the weaponizing of the US dollar, as strange as that sounds, basically forced these other countries to say, okay, well, what safe asset, and gold is a global asset, by the way. So what safe asset can we put our money in that's not US dollar? And that is gold. And so that's another reason you've seen the price increasing over the last few years.
Yeah, and even if they don't deem it necessarily as a safe asset, it's diversification, right? Instead of having all US dollars, they diversify in other assets.
Okay. So Ron, let's switch from like the government or the country kind of level focus down to the investor, like the retail investor level. Why do people invest in gold in the first place?
Well, the perception is when inflation goes up, gold goes up, so it hedges inflation. There's also perception when stock market volatility picks up, stock market goes down, then gold goes up. So if that happened consistently, that is an amazing asset to put into your portfolio. But I think there's a little bit of misunderstanding of what gold has done over time. And we can track gold for thousands of years. And if you look very long term, there's a report done by Campbell Harvey of Duke University. And in this report, what he showed is that gold has basically given inflation-like returns for a very, very long period of time. And the return is very similar to the return that you would get on cash today. Okay? And so how they can say that or judge the returns is, if you look 2,000 years ago at what a Roman soldier was paid, how many ounces it would take to pay that soldier, or a loaf of bread, how many ounces of gold would it take to buy a loaf of bread? And you go forward to today and look at what we would pay a soldier or what you would pay for a loaf of bread, it's about the same weight of gold that it would take. Okay. Meaning that over a very, very long period of time, gold has given inflation-like returns.
So is that the lack of understanding you're referencing? Because it's very common to hear that gold is a good hedge against inflation.
So for it to be good hedge, in my opinion, it should give you above inflation returns, because if you're only getting inflation-like returns and the risk of gold is similar to the risk of stock, so you have an asset that return has just been like cash, but the volatility has been like stocks, to me that's not good. And so then if it always protected against when inflation goes up, or always protected when the stock market went down, that would be great anyway, but it hasn't.
Yeah.
The correlation to stocks has been zero, so sometimes it helps, sometimes it doesn't.
So essentially what you're saying is that you're getting the risk of stocks,
right?
But long term, it's been the return of essentially cash. So why not
exactly.
go cash? If your goal is to just keep pace with inflation evenly,
right.
Why not go cash because it's a lot less risky?
Right. And when we talk about our framework, I'll talk about some other things you can do as well.
Okay. So focusing, on today, obviously, if you look at the price chart of gold, you'll see that it's, it's at its all-time high. And one thing that I want, to get across to the listeners is what the risks associated with buying things that are that expensive, especially if you compare them to their trend over a long period of time.
Right.
So Ron, can you hit on that a little bit for us?
Sure. So what's nice about, for example, stocks and bonds is you can value them based on expected cash flows. Okay. So for example, if inflation is 3%, we think that inflation is going to stay around 3%. If a treasury bond is yielding 5%, you know with a decent level of confidence that you're going to get a 2%. If you buy a 10-year bond paying 5%, you get about a 2% rate of return over inflation, right? So it's kind of easy to value that.
Yeah.
Stocks are a little bit more complicated because you're looking at expected cash flows. You're also introducing current valuations. Are they expensive or cheap? But we can still value it. With gold, it doesn't produce any cash flow. It just sits there and looks really pretty.
And costs money.
Carrying cost, right. And so because there's really no way, because it doesn't produce cash flow, to value it, the best way to look at gold is based on a longer term trend. So what we can do is we can look at like a 2,000-year trend, and we can look at a shorter trend, maybe 25 or 50 years.
Okay.
And if the shorter term trend is way above the long-term average, it may show that it's on a relative basis expensive and the future return might be less. On the other hand, if the price is significantly below that long-term trend, it may indicate, a buying opportunity. Maybe the future returns are going to be greater. Because, ideally, if you buy a great asset class when it's cheaper than normal, or in the case of gold, way below trend, you expect the future return to be much greater.
Right. And just to kind of reiterate that point, I know this is something we've covered at this point, probably several of our podcasts, but looking back at assets that do produce cash flows that can be valued, again, it's the more expensive an investment is, and if you purchase it at that price, the lower the expected returns tend to be looking forward. And so we're making that same point with this gold, but we're comparing it to its long-term average. So right now, the current price of gold is significantly above its inflation-adjusted long-term average. So what we're saying there is, while there's no cash flows to appropriately value it, that's one way of indicating whether you're buying it high or buying it low. And again, when you buy it high, it's just common sense that expected returns would look low.
Right, exactly. You're buying high based on a trend, more recent trend compared to long-term trend, right?
So the one thing that I'm curious is, so no cash flows, so you have to value it a different way, or do your analysis differently, and that's looking at the long-term trend. Obviously, gold right now is above that long-term trend. How long typically does it take for that relationship to reverse itself?
So let me answer that in two ways. First of all, if you take that report I referenced before, and
that's the gold standard report,
the golden constant,
the gold
by Campbell Hardy, and you inflate it till today, the expected valuation should be around 1,200. Okay,
right.
We're around 3,000, so we're a little above trend.
A little above it.
Yeah. And
by doubling then some.
Yes, by doubling some, then some, right? So these reversions to the trend, like if you're way above, how long does it take you to trend? Or maybe if you're way below, how long does it take you back up? They can last a long time, 10, 20, 50 or longer in way of years.
So if somebody's holding gold in their portfolio because they think it's gonna, either give them great returns or reduce the volatility or, be a great inflation hedge for them, And right now, again, it's, at 3,000, long-term trends 1,200, inflation adjusted. What you're saying is that there could, there's the risk that somebody is holding this asset, think it's going to do something for them that it might not do for 10 to 50 years.
Yes. Or it could be better than average for 10, 20, 30, 50 years or worse, right? Because it's really, these trends tend to last.
Right, but if you're looking at this, the way that we manage money for our clients,
right, this
would be something where you would be sticking away from it based on the information you have today.
Right, and I'll explain a framework that we use. Maybe there's a possibility down the road we use it, but again, I'll get into that a little bit.
I know we all read that report, which was, served as inspiration for this episode topic. There were a lot of graphs in there. Is there anything that you guys want to highlight and bring up on the video during the podcast to kind of further drive these points home?
Let's put the chart up on the screen that we have from Research Affiliates. So Research Affiliates is an investment firm that does great work related to asset allocation and risk and return of various asset classes. We use a lot of their data. This chart data runs from January of 1975 up until March of 2025. And there are 3 lines on here. So the black line is inflation. The green line is the real price of gold, adjusted for inflation. And the blue line is the nominal price of gold, not adjusted for inflation. The lines are just graphing the 10-year return for each period in the chart from the start date. Okay. So it starts with 1985 because that's the return from January 1st of 1975 to January 1st of 1985. Okay. And what you see first is that when you look at the green and the blue lines, when there are high peaks on the chart, those periods where gold returns high into the double digits.
Way over inflation
return. And then you'll see that the price the return is underperforms subsequent to those peaks when you buy at those highs. And then often there are periods after those peaks where the return trends down and it returns like from 1990 to 2005, gold returned way under inflation, actually. So this gets back to the point, 2 points. The first point is when you want to pile into gold after the return has been really, really good, the historical data indicates that's not a great idea from just statistically. The other thing is this illustrates how unreliable gold is in terms of its performance relative to inflation. There are periods where it massively outperforms inflation, like 2005 to 2020. And then we already talked about that 1990 to 2005 period, pretty dramatic underperformance versus inflation.
Yeah, and most people, to put gold in a portfolio, we have to take something from the portfolio. And most people will have a hard time with 5, 10, 15 years of underperformance. They lose confidence, lose interest in an asset class, oftentimes sell it, normally at a not an opportune time, maybe when it's lower, and then it starts to outperform, and then they gain interest again. So they tend to be chasing instead of doing it in a more logical manner.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
So, I certainly can't speak on behalf of everybody, but to speak for myself, I know when we were putting, this episode together, the talking points, I learned a few things that I didn't necessarily know about gold. Maybe have heard of, but not to the full extent that I do. So I think it's safe to say that something in this episode, even if you have your most well-versed investor, there might be something that they weren't fully aware of that we've discussed in this episode. Taking that a step further, is there anything that, not focusing on like the physical numbers, the valuation parts of it, but the behavioral finance side of things, is there anything behaviorally that kind of alludes to the tendency to want to purchase a safe haven asset at an opportune time?
You can apply what we'll talk about to actually any asset, but within the context of safe haven. So first thing that people do is they move in herds. particularly investors that don't have, or that aren't high information investors, like plugged into the frameworks we're talking about, plugged into the data that we're talking about, they will tend to say, what is the crowd doing? And do what the crowd is doing because it makes you feel good. It makes you safe because everyone's all in it together.
Right.
You know, and
the headlines motivate people.
The problem
In
with
masses.
the problem with that is that if you're further down the trough, so to speak, from like the center of the financial market to like where we sit more on the retail end of the spectrum, by the time the herd is big enough that you are finding out about it and wanting to join it, the people who are really at the leading edge of the herd are kind of thinking about selling to you so they can move on to the next.
And those people are, you would look at the people that are kind of like at the leading part of that is like Wall Street.
Those are your pinstripe cuffling guys, you know, Ron in the 80s, maybe doing his Gordon Gekko thing. Yeah. If that was a thing you did back then. Yeah. So you want to be wary of falling into that trap. That's very common. Related to that is something called recency bias. And we talk about this all the time on our podcast. It's driving in the rearview mirror. Oh, gold is really high year to date, therefore it's a good investment and I'm going to buy it now.
Yeah, whatever's happening now, you just think and predict that it's going to continue to happen.
Yeah.
And you don't pay attention to valuation or to trends.
And the last one I mentioned feeds into both of them. It's just emotions, which we all have. I mean, you have emotions about your money. I have emotions about my money. Ron has emotions about my money. What we strive to do is layer these frameworks that we talk about that over top so that we aren't letting our emotions guide the decision making. We're letting the framework guide our decision making.
Yeah.
And I'm not going to sit here and say I'm superior to anyone in the markets or the audience. Like, it's green numbers feel good, red numbers feel bad.
And Nick, I take exception. I'm not emotional.
Yeah, right. It's okay.
But other than most people are. It's not
I really find the herding behavior concept that's taught in behavioral finance just to be really interesting, and how it specifically talks about, you know, essentially Wall Street will basically do the opposite of what retail investors will do. Whenever they start realizing that retail investors are flocking onto, or like, you know, the masses are coming onto a trend, that's when they start to say, okay, I'm going to realize my profits and I'm going to get out.
Well, and also,
I think it's incredible.
Yeah, related to that too, if you look at what a lot of mutual fund companies will do is when there's some trend out there that's, you know, something in the headlines is really, really popular, you know, it could be EV stocks or biotechnology or the .coms. All these products are coming out to capture that interest.
Yeah.
But the problem is when everyone's bringing these products out, it tends to be at a bad time.
Well, and you also, but you have to think, like, for the fund company, of course they want like the funds to perform well, but
they also want cash flows.
They want, you know, if they release a fund that's, let's say, is an EV fund, money's going to go into that. Right. They're making money off that, whether the market's up or down or not, because they're charging fees on that fund specifically. So
performance is great, but really what matters is like whether their assets staying in the fund, and hopefully into the fund.
Right.
Yeah.
So two more questions or 2 more points that I want to get across here. So we go back to Ron. What do you like and dislike about gold as an asset class?
So I mentioned it earlier, but I think the primary positive of the gold is it's not very correlated to stocks or bonds. So there is absolutely a diversification benefit to gold. You know, sometimes stocks do poorly and gold does well, and sometimes, you know, they both do poorly.
So could you explain that in the context of what you said earlier, which was gold's carry about the same level of risk, which is measured by standard deviation.
Right.
They carry about the same level of risk as stocks, but you're saying that the correlation is low. So can you just make sure that point's brought out full circle?
So let me compare it to this. So say you have U.S. stocks and international stocks. Mm-hmm. They tend to be very highly correlated. When U.S. stocks are down, international stocks are very likely to be down too. Maybe to a greater or lesser extent, but they tend to track each other very well. There's a decent amount of times when the stock market's down and gold is up, but there's also other periods of time where they're both down, right? So that's correlation. Do they always go up and down together or not? Gold, the correlation is like 0 to stocks. bonds can add some diversification to stocks. Correlation depending on the times.
And quality of the bonds too.
Right, can be maybe 50, right? So
Yeah.
they can be, so correlation is one of the main advantages.
So when structuring a diversified portfolio, the best way to do it is have asset classes that do have low correlations with each other.
Right, lower
Gold
non.
improves the risk characteristics of a portfolio when you add it. That's an important word.
Right.
Portfolio.
Right.
When you're not viewing it in isolation. The problem is that it tends to reduce the return also.
Okay.
In a way that's not attractive.
Right.
Gotcha.
So the cons, kind of like what Nick's saying, is returns historically have been about the same as inflation, same as cash. It's not that reliable of a hedge, meaning sometimes when inflation is going up, gold provides a great hedge, and sometimes it doesn't.
Mm-hmm.
And as we've said multiple times, very volatile. You have an asset that's as volatile as the stock market approximately, with returns that are more similar to cash.
One thing I'd like to add related to unreliability and volatility, and you see this with everything that's classified as an alternative asset that's uncorrelated. It's very difficult behaviorally to stick with that a lot of times. If you went through the period owning gold from about 2013 to 2020, the returns were awful. It was a huge detraction from your portfolio. And it's very difficult for a lot of investors, even professionals, to stick with an asset for 10 years of underperformance when all you see is detraction.
Right, you have to remember that when you add gold, you have to take something from your portfolio.
Right.
So what do you take from your portfolio? And that's kind of what I'll get into next.
Yeah. So I know where we're going next, and we've done an episode on this in the past, but at our firm, we have a proprietary investment making decision framework,
Right.
Okay, called the all season framework. And so if you want more context on what the all season framework is, how it works, really what it's meant to do, please go back and watch that episode. But Ron, what I want to ask you for the final question is, how does gold fit into that all season framework?
So now it doesn't, we don't have it in our framework. Now, if the price came down a lot and got to maybe trend or probably below trend, then we might consider it.
Okay.
But now, so if you look at the appeal or the potential appeal of gold is hedging against inflation and hedging against the stock market doing poorly. I think that's would cover most of it. So in our framework, we have treasuries, intermediate and longer term treasuries, for when there's a recession, when rates are going down, the stock market's going down, right? So those help in that environment. But those assets do not help when there's inflation. So on the other hand, we're using private debt and also publicly traded treasury bonds that are floating rate, meaning when inflation's going up, interest rates tend to go up, and both of these investments will pay you more and more and more as interest rates go up. So they're a great hedge. So on our bond side, we're yielding a good 6%, and we have it set up in such a way that it helps hedge the stock portfolio, because that's where the risk of a portfolio is, both when there's a recession or when there's inflation. So that's how we're doing it now. We're getting paid a cash flow, right, in this environment that's much better than cash or much higher than long-term inflation.
I want to go back to one thing that you said really quickly, because I know we've talked about gold being an inflation hedge a lot in this episode. And so far what we've been saying is that if you look at it over the last 2,000 years, it basically has just kept pace with inflation. You're saying that it could, right now it's not in the framework, it could fit into the framework.
Sure.
And two reasons why you think it could fit in the framework are that it has a low correlation to stocks and it could be a good inflation hedge. And it has been in the past for periods of time, not over the whole 2,000 years. So in order to see that inflation hedge possibility kind of enter the equation, the price would have to come down.
Right, I'd have to buy it when it was noticeably below trend.
Gotcha.
Yeah.
Okay. for our clients, that tuned into this episode, we hope that you found this informative. If you have any questions or want to explain this further with us, by all means, please reach out. We're happy to schedule a check-in meeting to do so. If you have a friend that has been bringing up gold lately, and we're not talking about going and getting, a gold chain at the store. We're talking about investing in gold. Feel free to share this episode with them. And for anybody that's not a client that listens, if you have any questions or just want to further explore what our framework looks like and how people have been benefiting from it, our contact information has been shared several times throughout the episode. Feel free to reach out.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.